If you're watching this, there's a good chance your mortgage is getting close to renewal. And just like millions of Canadians, you're probably asking yourself the same question. Should I go fixed or variable? Maybe the renewal letter is sitting on your kitchen counter. Maybe it's buried in a drawer. Maybe it's sitting in your inbox because you've been meaning to deal with it later. And honestly, I get it. Mortgage renewals aren't that exciting. But here's the reality. That renewal letter could be one of the most important financial decisions you make over the next 5 years. It could be worth thousands of dollars. Hey, I'm Brian Hogben with Mission 35 Mortgages. Every day I help Canadians navigate refinances, debt consolidations, mortgage renewals in order to help them build wealth through real estate. Right now, the number one conversation I'm having is, should I go fixed or variable? The truth is, I can't tell you whether fixed or variable is right for your situation. Your income matters, your goals matter, your property matters, your timeline matters. So if your mortgage is renewing in the next 120 days, click the link below and my team can connect with you on your specific situation. We'll review your goals, compare it against what's available in the market, and build a strategy based on your goals, not just the rate the bank put in front of you. Now, with that said, let's talk about fixed versus variable and what I'd be looking at if it were my mortgage. Biggest questions I get asked every day: why are Canadians so worried about mortgages renewing today? Many Canadians took a 5-year fixed rate anywhere between 1.5% and 2%, which is going to be coming due soon. Now, the interest rate is going to be almost double for some of those mortgages, but that doesn't mean the payment doubles. The payment is based on a function of not only the interest rate, but the amortization too, which is the length of the mortgage. So even though the payment will increase, it will not double with the interest rate going up so much. You're probably reading headlines all over social media and Instagram that prices are plummeting. Now, prices have got down, but it's all relative to different areas. Two things I want to compare to. Sales is the actual number of units of houses that are being sold, is very different than prices going down. So make sure you're differentiating between the two. And also, not every geographic area in Canada is created equal. If you're downtown Toronto versus downtown Hamilton, prices could actually be increasing in your area versus decreasing. Take Durand or West Mountain in Hamilton, for example. Those prices are actually doing quite well compared to a condo downtown Toronto. You have to strip out a condo because condos aren't doing too well today, but single family homes and townhouses are. So depending on what you're renewing, depending on what you're purchasing, this is going to affect your property value specifically. For that person who's taken on too much debt and we can't refinance everything, we recommend a fixed rate. And I'll tell you why, is because if you haven't budgeted for the past 5, 10, 15, 20 years, the chances of you doing it now is very slim. So it's important for you to have at least something that is 100% secure that you can count on every single month. That's your mortgage payment. Everything else, I'm going to tell you to budget. I'm going to tell you to put money away for it, but you haven't done it in the past. So in those cases, take a fixed. You know it's not going to go up. You know it's not going to go down. And you can make sure that it's always paid every single month. Typically, you're compensated for taking a variable rate mortgage anywhere from 1/2 to 3/4 of a point. That's usually the risk premium that you take when you have a fixed rate, because on the fixed side, it's never going to move. But on the variable rate, it's in the name, it could go up and it could go down. So currently you're looking at anywhere between 1/2 and 3/4% cheaper from a variable rate to a fixed rate. That's where the risk lies, because when the Bank of Canada decides to move their rates 1/4 point or 1/4 point, that risk premium gets reduced every single time the Bank of Canada moves the rate up. Are Canadians actually in worse shape than they were 5 years ago? I get asked this a lot. The reality is some of them are, but a lot of them aren't. Number one, because of the stress test. 5 years ago, if you got a mortgage at 2% or less, you had to qualify at an interest rate of almost 5.25%. That means that you were stress tested for a payment that was more than what it's renewing at today. Number two, income has gone up significantly in the past 5 years. We've seen some inflation, especially as of recently. Most people are making more money than they were 5 years ago if you're still employed. I want to talk about equity positions. If you bought the worst possible time was 5 years ago, you're still in a decent equity position, again, depending on your geographic territory. Here's why. Because with interest rates being so low, majority of those monthly payments went towards principal and not interest. I'm going to show you an example here. On a $750,000 mortgage, you probably put down at least 10% if you bought it within the past 5 years. With interest rates so low, at the 1.5% to 2% rate in 2022, the majority of your payment went towards principal. So on a $750,000 house at an interest rate of 2%, you would have paid almost $75,000 off your mortgage. Now, if you have a $750,000 mortgage, chances are you had at least a 10% down payment on your purchase 5 years ago. So that is a 20% difference right there from the time that you purchased it. The strongest argument for a variable rate right now is it's cheaper than a fixed. It's almost 3/4 of a percentage point cheaper than the fixed rate. So that means lower monthly payments, lower monthly interest costs, and more money going towards your principal. So people who budget and have been spending below their means and are not living paycheck to paycheck, if you're a conservative person, I would take the gamble on the variable rate mortgage because you're being conservative everywhere else. You could afford to take that risk and potentially save some money over the next 5 years. The strongest argument for fixed, and I see this a lot with first-time home buyers, I call it sleep insurance. Basically, it means you can sleep at night without waking up in a cold sweat worrying about your mortgage. If you take a variable rate, a lot of people are worried about when it goes up, when it goes down. The Bank of Canada meets almost 10 times a year. Do you want to have a panic attack every single time they meet to see whether or not it's going to affect your mortgage? If the answer is no, the fixed rate is the option for you. At the end of the day, the fixed rate gives you certainty. And also, for my families out there that are already feeling stretched, if you feel like you're at the max of your budget right now, credit cards, lines of credit, other expenses, and you can't consolidate everything, I would end up taking the fixed rate so you can start to know exactly what your payment's going to be. Trying to save on a variable at the risk of that payment going up could be very detrimental to your finances. A word of caution on the fixed rate though, they do carry the biggest penalties. So if you have any inclination that you're going to be selling or moving, changing jobs, something where you're going to be getting rid of that primary residence where you live, then you should consider not locking in for 5 years or a variable rate because the penalties can be financially disastrous in a 5-year fixed rate. Here's the biggest thing to understand about rate forecasts. Nobody knows for sure. It's like the weatherman trying to predict the weather. The closer you are to the date, the more accurate you're going to be. If the Bank of Canada is meeting tomorrow, chances are I can tell you what they're going to do. But the Bank of Canada that's meeting 30 days, 60 days, or 90 days out, I can't tell you with certainty what's going to happen. And neither can most economists. And you know why? Because all the rate information is based on the data points that come out before the rate announcement. If unemployment goes up a week before the rate announcement, that's going to have an effect. If consumer price index, if CPI, GDP, inflationary numbers, they are all going to move on a monthly basis as those numbers come out. Those numbers are going to drive interest rate decisions. Every single time you see a rate forecast, it's based on the most recent numbers. And that's why they will constantly change. If you really want to drive yourself crazy, try to predict rates all the time. Guaranteed you won't be right. Personally, right now, when it comes down to interest rate, I feel like we're in a normal market. A normal market will see things go up a quarter or a half, then down a quarter and a half. That's typically how interest rates will move. What we've seen over the past 5 years, quite frankly, is just not normal. We saw interest rates double, triple, go from 1, 2, 3, 4, 5, 6, 7, then go back down, 7, 6, 5, 4. That is like a wild roller coaster. And that's just not the norm. For the amount of time that I've been in the business over the past 20 years, quarter point, half point, 3 quarters over the course of a year is very normal. And that's what I foresee happening over the next 12 to 18 months, barring any other world wars or unforeseen wild incidents that we can't predict. You have to remember, this is the lever that the Bank of Canada uses to control our economy. If things start heating up, They pull the lever on interest rates in order to cool it down, which means raising rates. And guess what? If they pull the lever too far, then they put it back up again, and then they'll decrease interest rates to get the economy going again. So this is what the Bank of Canada normally does. It's almost like operating a boat at sea. If you overcompensate left too much, then you got to overcompensate right a little bit. And this is what the Bank of Canada is meant to do with subtle shifts on interest rates. We've only seen wild swings lately because we've had wild events in the economy, and it's not normal to have wild events in our economy that affects interest rates so much as we've seen over the past 3 and 4 years. If I was renewing my mortgage tomorrow, and let me tell you, I'm still an avid real estate investor and I have multiple mortgages, I love variable for my investments and fixed for my primary. And I'll tell you why. If I need to sell any of my investment properties, a variable rate mortgage carries only a 3-month interest penalty. Very, very easy. And so long as you purchase your investment properties and are at a good cash flow situation, you can maximize your cash flow with a variable rate mortgage. It gives you flexibility. And in my opinion, if you bought right, maximizes your cash flow. For my home, where I live, where my family is, I want certainty. I want peace of mind. My home is not an investment. My home is where I live. So I want to make sure that I know exactly what I'm going to be paying every single month on there. So if you read between the lines there, what I like is a diversified strategy. But because I have multiple mortgages on multiple properties, I split it up between primary debt and rental property debt. This is by far the biggest mistake I see people making on mortgage renewal, and that is waiting too long. If your maturity date is coming up and you're less than 30 days away, you may have already waited too long. In order to actually do the shopping, get an approval, get a good mortgage, it'll take you a minimum of 2 to 3 weeks. So starting anywhere outside of that, you're missing out an opportunity of shopping your mortgage, looking for a better interest rate, and negotiating it with a mortgage professional on something that is probably the biggest investment decision of your life. It's your home. That's the biggest debt that you're ever going to get. So interest rate isn't everything, but it is important when it comes down to that debt. When you go to your bank for a mortgage renewal, this is my number one pet peeve, okay? Some people think, oh, I've been with my bank for 10 years. They're gonna take care of me. I opened up my first bank account there. They're absolutely amazing. It's bullshit. This is what the bank typically does. They end up saying, hey, Brian, here's an interest rate of 4.5%. But if you're shopping around and you can find better, we'll beat that rate and give you a better interest rate. Do you hear what's wrong with that? That's basically the bank saying there is better interest rates available, but we're only going to give it to you if you find it. So that's why you come to a mortgage broker, because what they do is they shop. When you go to a bank, they can only offer you one product, and they're not even offering you the best upfront unless you find it somewhere else. So guys, who do you want to deal with? Do you want to deal with someone who actually has integrity with your finances, or someone who legitimately tells you to your face that they will charge you more unless you go do the work and find less? And that's what we do at Mission 35 Mortgages. We shop over 50 different lenders on your mortgages. We look for the best solutions based on your goals. When you actually renew your mortgage, there is so much more than just renewing your interest rate. It is the perfect opportunity to look at any debt restructuring. Have you spent a little bit more money? This is the time to wrap it into your mortgage as well too. Now, you don't necessarily have to make your mortgage longer. Carrying debt on your mortgage is traditionally the cheapest debt facility one can have. The reason being, mortgage debt, it's secured with your house. If I have a Visa card, it's unsecured. Unsecured debt means if you don't pay it, there's no security for the bank to get. That's why secured debt, your mortgage, is going to be cheaper debt than unsecured debt, your Visa cards or credit cards. So at a mortgage renewal, great time to look at debt consolidation. 2, do you have any major renovations coming up? Windows, roofs, doors, floors, kitchens, bathrooms. These things aren't $5,000 or $10,000 anymore. Instead of just putting it on a credit card 6 or 12 months from now, Plan ahead with your mortgage renewal and take out the renovation money so you can pay it off with your cheapest borrowing facility possible. Are you thinking about retirement yet? Because many of us start to think we just pay down the mortgage, pay down the mortgage. If I pay down the mortgage, I'll be okay. Guess what? It's okay to do both. If you've got a lot of equity on your mortgage renewal, take some money out and get it working for you so that way you can build your investments at the same time as paying down your mortgage. Because the worst thing you can do is pay down all your mortgage and then start investing, because you miss out on one of the biggest investment secrets of all time, and that's compounding. The more time you have to invest your money, the more you can make. Now, on variable rate mortgages, the ones who I advise should absolutely take a variable rate mortgage are my rental investors who are considering selling. There's a lot of people with investment properties right now who are maybe underwater, treading water, or just not sure what the game plan is for the next 1 to 5 years. If that's you, take a variable rate, because number one, currently, you're going to save some money because the cash flow is going to be better, because the interest rate is going to be cheaper than a fixed. But number two, and the most important one, is that you only have a 3-month interest penalty to sell at any time throughout that 5-year term. Should things change, you decide to keep the property and have a longer term vision, remember, you can always convert the variable to a fixed rate with most lenders. They'll allow you to lock into a term that's of equal or greater duration than where you're at. What does that mean? If you're 1 year into a 5-year variable, you could lock into a 4-year or a 5-year fixed. If you are not doing good with your budget, if money is not being met, and if you have anxiety, you worry about things, and you lay awake at night sweating thinking about your finances, do not take a variable rate. It is not going to help your finances, and it is not going to help your lifestyle. I'll tell you who loves the fixed rate right now. It is my first time home buyers. And the reason being is because they crave certainty and security. And why wouldn't you on buying your first house? I think it's a great idea for first time home buyers getting in a 5-year fixed. If you're close to the max budget, things are expensive right now still. So if you are close to your max budget, taking a fixed rate is not a bad idea. In addition to that, you should absolutely take a fixed interest rate if your income will never change. If you have a salaried income with a very potentially small bonus, small overtime, I love the fixed rate for you because nothing's going to change. So might as well lock in that payment, lock in that budget so you know exactly what to pay every single month. If somebody sent me a renewal letter tomorrow, these are the first 3 things that I'm looking at. Number 1, amortization. Amortization is how much time you have left on the mortgage. Do you have 25 years left? 20 years left? The reason this is important is because when I look at the amortization, I instantly know what I can do with your payment. Can I make it bigger or smaller before we get into your goals and budget? The second thing I'm looking at is I'm looking at the balance on your mortgage when I look at your renewal letter. I look at the balance and your address, because looking at those 2 things, because I'm an expert in the areas, I'm going to have a pretty good idea of what your equity position is. I'm going to be able to tell fairly quickly whether or not we can add money to your mortgage to help out, whether we can stretch out your mortgage, or whether we're just going to have to renew with exactly what the bank offers. And sometimes that is the case. The third and final thing I'm looking at as soon as I get a renewal letter is the maturity date. Do we have time to actually switch your mortgage, change your mortgage, or shop for you? If you waited to the last minute, you may have a penalty. You may be stuck into a locked term on maturity. You may have to renew into a very high interest open rate. That all costs more money at the end of the day. So that maturity date, again, make sure you're addressing your mortgage renewal 6 months before, 5 months before. Don't wait until 2 weeks before, because you're only hurting yourself and the amount of money you can save with your biggest asset you're ever going to own. At the end of the day, fixed might be right for you. Variable might be right for you. It's just important that you understand and know your options, because the difference between a good mortgage decision and a bad mortgage decision can literally save you or cost you thousands of dollars over the next 5 years. If your mortgage is renewing in the next 120 days, click the link below and my team would be happy to connect with you to build a strategy that's right for you. Now in this video, we've talked about fixed and variable rate mortgages. But here's the bigger conversation that we should be talking about. Most Canadians aren't losing money because they chose fixed, and most Canadians aren't losing money because they chose variable. They're losing money because they blindly accepted the bank's offer. So in my next video, I'm gonna break down the biggest mistakes Canadians make when renewing their mortgage and how to avoid them. My name's Brian Hogben with Mission 35 Mortgages. Please comment, like, and subscribe. And if you think this video can help anybody in this situation, please send it to them. And if you have any questions, please leave them below. We'd be happy to answer. Thanks for watching and make this a fabulous day.